Good morning, everyone. I'm very much used to this set room, that's where I teach my ESG class as well. So I'll try to keep it under 10 minutes like the previous speakers and not like 3 hours, 20 minutes. You'll not like me for that. So thank you to Alex for setting the scene, because I'll just pick up on these issues and I'll make it a bit more graphical. More numbers, more charts. If I just have the, oh, it's there, just, yeah. So 5 years ago, I was invited in a workshop from an asset manager, and I had to speak about empirical finding on ESG investment. And 5 years later, I'm doing the same thing. So the question is, why do we have to talk about findings in ESG? And I believe the reason is because the audience or the market is confused with such a large taxonomy in this field. CSR, SI, SRE, ESG, CSV, value-based, etc., etc., etc. Okay. Okay, I speak closer. So, one thing I like to point on this discussion, on this presentation, is that ESG investing is not ESG reporting, is not CSR. So we don't have to emphasize too much on empirical finding. ESG investing is risk management. And as you progress through that, is value capturing and generating alpha. So like any other risk management technique, there is value in it. So it doesn't have to be disputed. So let's go on with my agenda, which is first, we have to set up the scene. ESG investing is risk management. Number 2, ESG investing is a discipline, it's an investment discipline, and as such, it needs to be structured. You have to have a structured approach in how you tackle ESG issues. Number 3, again, findings. I'm bringing some findings. ESG is positively related to company performance and other variables like beta and volatility, etc. Most importantly, governance. Among E, S, and G, governance is the driving factor. It has been and is still there, although less so in Europe, but still very strong in Asia. Number 5, ESG investing in isolation leads to underperformance, and that's where all the confusion comes. ESG findings tends to be not 100% robust, sometimes positive, sometimes negative. But if you dig down into the methodology, into what ESG strategy is being implemented, what kind of market condition you're implementing, then the results make sense. So ESG cannot be applied in isolation. It's part of the whole financial and risk analysis. Number 5, I'll touch very quickly on the green bonds. And to conclude, you'll see that, or from this panel, from this presentation as well as the panel, we'll see that one of the biggest push in Asia for ESG has been from large institutional investors. Alex already mentioned this. Is the same study, is from Global Sustainable GSIA. The point is, I would like to make is that there are 500 billion ESG assets in Asia, and out of this, 90% of these are managed in Japan and only 10% in Asia, excluding Japan. So that makes the ratio of 0.2, which is less than 1%, managed in Asia only. Which is bad news, but it's also a good news because there is room for growth, right? So let's look at the positive side of that. The growth in Japan, as you know, is because you come from the market, is mainly driven from pension fund, which is lacking in Hong Kong. So that's one of the reasons. This I talked shortly is coming from PwC. In 2013 is very relevant still now. ESG is risk management as you early come into the field, but through innovation and cost saving, you move to value enhancement for the company, right? So these are early stage ESG implementation, late stage, you move from risk to opportunities. So that's a natural path of ESG integration into the business model. Again, ESG investing is a discipline approach. Sorry. For this, you need a structured approach, or how you tackle ESG. What are your key ESG areas to focus? In one of the reviews from the KPMG, which was released a couple of months ago, they found out that around 18% of the companies report material ESG factors, ESG indicators. The rest will just report any indicator. That's one of the key issues where you get mixed findings in empirical results, Because if you throw everything in, then what you find is all over the place, right? So we have to focus. First you start with KPI indicators, then you focus on financially material indicators, and out of this, still good, not enough. You have to do some more what we call a risk assessment or risk heat map. So you look at the degree and the size of the impact of this indicator on a company cash flow. Okay? So not all of these indicators are relevant, only the ones which have a high probability of happening as well as a large size. So you focus on like 5, 10, and then you dig down on these indicators. You perform stress test scenario. Any kind of equity analyst or fixed income researcher will do that kind of, is a typical structured approach to risk analysis. ESG is risk, so you have to manage your risk in a structured approach. And companies have to come up with a structured framework and systematic framework on how they analyze the ESG. It's not, they don't have to get lost in the data. They don't have to gather data which are data for KPIs which are not relevant, financially relevant for the companies. So this will be also one of my recommendations for the SFC. So they come up with either the list, kind of a shortened list with a key material indicator per sector for the companies. So that makes the life of the company much easier. They know what to focus and they know what kind of data they should be gathering. Okay. To move on, findings. Does ESG bring value to the company? Now this is better than your research. This is research based on initially 3,500, then they cleaned up for double reference on the same paper. So there's 2,200 papers behind, 10 times the Oxford paper. So that should be very confusing. The finding here says that in developed Asia, 33.3% of the empirical findings point to a positive relation between ESG and corporate performance. 14% are neutral, 14% are negative, and the rest is neutral. Okay. Emerging market is even higher, 65%. And that's about ESG. ESG indicators are very important because they give you the kind of data which you miss in emerging market. Emerging markets lack data and transparency. So by digging on the ESG data, you get this kind of granular information about governance, about how they handle the environment and social aspect, which help makes better informed decision for asset valuation and asset management. Now, the other point which is very important is that among the three E, S, and G, these are three factors inside. They are highly correlated. Correlation can go from 0.6 to 0.9 in Asia. The G is the most important factor. So the governance is the most important driving factor within the ESG framework. So if you just focus on G, you're capturing E and S to a certain extent. Not in China, because we know that ESG in China is driven from, is a top-down policy, but the rest of Asia, if you focus on G, then you'll get some, you get also the E and S there. We did research with the Robeco a couple of years ago, not too far long ago, with their own data. Then we found that we did on E and S and G, the governance was a stronger indicator. The governance is a leading indicator, so improvement in governance, so you get the momentum in governance. So improvement in governance will lead to higher stock price return, and that was stronger for Asia. It was 70% stronger signal in Asia than the rest of the world. Improvement in governance increase future PE ratios. Improvement in governance indicates lower volatility for the years to come, and improvement in governance indicates a lower systematic risk, lower beta. So that was for Asia, and then we compared Asia to the rest of the world and other causality factors, whether G drives E or whether E drives S and G, and you name it, academic studies. The point is, governance is very strong in Asia, and is stronger than the rest of the world because we do have some learning effect. In Europe, will be much weaker. Investors there, they know how to read the G. Here is still a learning process, so that's where you can also use it as an opportunity to capture companies with improvement in G. Okay? Not going through that in details, but there are more and more studies. Overall, if you're on a more granular empirical findings, we see that ESG brings alpha, ESG lowers the cost of equity, ESG lowers the beta, ESG lowers the total risk, ESG engagement brings excess return, so abnormal return, alpha. On the cost of debt, you have positive, negative. Studies now coming more on negative. It means higher ESG, lower cost of debt, which is good. But initially, 5 years ago, the studies will point to a higher cost of debt, and that's linked to the low-quality borrower. So if you do ESG, if you do, it was CSR at that point. If you are a company and you invest in money in CSR, but you are a low-quality borrower, the market will punish you for that because you're wasting money. So it's that's a reality. So the market is smart in knowing at which point you can invest in ESG and which point you have enough money to improve your internal risk management process. Time is up. They don't let me. I think that's the most important one. No, it's one of the two charts which are important. That's a sustainability index in yellow and the the Hang Seng index in purple is outperforming. However, am I going to sell you this product? No. In the sense that it's not ESG driving it, it's a size factor behind. The same, we have other charts here, which I'm not going to go through. The point is, you can't just do an ESG strategy just looking at ESG. You'll get mixed results. It has to be mixed up or together with other financial indicators or risk factors. There you have to control for size, volatility, dividend, momentum, etc. There's a high correlation between ESG and other factors. The last one, that's green bonds overall. Asia is around 40%. That's as 2017. And within Asia, China is half. Where is the issuance coming from? In terms of size, is from the government, but in terms of number, is corporates issuing. So that's a very positive for ESG in Asia. One problem with the government, with the green bonds, which is coming up, is the risk behind the green bonds, which is not properly assessed. Companies issuing green bonds are coming from utility materials. They tend to have high climate risk. If you look at MSCI heat map projections, so how much of this risk is priced in the green bonds? There's no premium. But we have done a study through all the countries. There's no premium, but are the risks really priced in the green bonds? And to what extent? With that, I have a couple of slides, but we can do that during the panel discussion. Thank you.